So this is problem 2, formation. You have lemon, lime, and orange, 3 cash method, individual, calendar year owners. Form Starburst General Partnership to create fruit candies. Before this partnership, they each had their own sole proprietorship. So the partners contribute the following pieces of property. It's important to note that net, they're giving up $100 worth of value because you're going to see some of them have liabilities. And they each get a 1/3 interest. That's obviously critical. Anytime you have a partnership problem, focus on the ownership and the capital, profits, and losses of the partnership. Partnership assumes all liabilities, encumbering the assets. So Lemon is going to contribute land, fair market value of $430, and recourse mortgage of $270 on that piece of property. Lemon has held the land for several years as an investment. Its basis in the land is $100. Lemon also contributes $40 in cash. Lime contributes a building. The building has a value of $260 and has a basis of $130. There's a recourse mortgage on that of $60. Orange contributes 0 basis accounts receivable worth $350 and assigns his accounts payable of $150 to the partnership. Okay. What are the tax consequences to each partner and the partnership on formation? Also consider any potential future issues with respect to these transactions on the partners or partnership. And then there's also some items to note when I'm doing my analysis. I put these here because for those of you that might be watching this that are more advanced tax people, you might be like, well, what about disguised sales rules or 704C allocations or, liability allocation? We're just going to assume that all liabilities are going to be split equally, which kind of makes sense because they have equal profit and loss ratios, even though there's both liabilities are recourse. Even if they were non-recourse, we would do the same for the assumption for this question. Okay, so one thing is this problem goes along with formation problem 1. So if you haven't watched that one yet, please watch it. That problem, we go over balance sheet and how we set things up. The focus of this problem compared to problem 1 is liabilities and how liabilities affect the basis, outside basis of the partners and their interests. And you're also going to see that some partners may even have gain due to liability relief. Again, the question's asking for the tax consequences to each partner and the partnership on formation. So with that, we're going to start with the partnership. Under section 721, no gain or loss. And the reason why is because each partner is giving up property and in exchange getting a partnership interest. Now, just because you have a liability on the property does not stop that rule from occurring for the partnership or the partners. Now, there's some special rules for the partners we have to look at under the 752 deemed contribution, deemed distribution rules, and we'll talk about that when we get to the partners. But with respect to the partnership, right, Lemon's giving up land, that's property, cash. Lime's giving up a building, and Orange is giving up accounts receivable and accounts payable. So, no gain or loss to the partnership. With respect to the inside basis, inside adjusted basis. Now again, in problem 1, we actually created a balance sheet, and you can do that, the same thing in this problem. The key difference is that now we have liabilities that the partnership has to record, and of course that goes into the accounting equation, right? Assets equal liabilities plus owner's equity or capital. But for purposes of section 723 inside basis, the partnership's going to take cash, the accounts receivable, the building, and the land. It's going to carry over the bases of those items. We have 40 for cash. There's no basis in accounts receivable because it's cash method. 0 basis accounts receivable, cash method to Orange. The building has a basis of 130, and the land has a basis of 100. So the partnership takes those items at those bases. And per section 1223, they all tack. They all get to add on their holding period, everything. Now, under the liabilities, there's also going to be accounts payable. The accounts payable have a zero basis because, again, Orange is a zero basis taxpayer. Cash method taxpayer. So you haven't recorded anything yet in those respective items until you actually collect. So that's the partnership. Let's look at the partners. When it comes to liabilities, and this is formation, it's a two-step process that we view together. Now, of course, as you all know, Section 721 applies to both the partnership and the partners, right? That same rule, no gain or loss. Okay, so that rule applies to the partnership and the partners. But if there's liabilities, we also have to consider Section 752. Now, with respect to the partners, we also have to worry about Section 722 and carry over the basis, just like we did in problem 1. Right? We carry over the adjusted basis for each partner. So the idea here, when you have liabilities and contribution or formation of partnership, is you could think of it like two separate steps. First step being the 721, 722, and then doing the 752 analysis. But really, for tax purposes, it's all the same event in determining the ultimate tax consequences. So that's how we're going to go about viewing this. Okay? So we have lemon, lime, and orange, and they're starting adjusted bases per section 722, right? That's the carryover basis rule. Look at what they're giving up. Lemon's giving up land, has a basis of 100, also giving up cash of 40. So lemon starts with 140. Lime is giving up just a building, has a basis of 130. And orange is giving up two assets. An asset and a liability. Both have a zero basis. So what we have to do, again, think of this like two parts, but it's all the same tax transaction. The first part is we've just gone through and done section 721 and 722, just like we did in problem 1. Right? No gain or loss to the parties on the initial formation. That's step 1. And then you took a basis. However, the liability issue, right? Lemon, lime, orange, they all contribute liabilities. That liability issue also has to go into that same transaction. So what we're going to do is we have this chart. I create this chart. What this chart does is it tracks our basis going forward as you take into account all the liabilities that are relieved and taken on. Now, at the end, if you have a negative basis, you can't have negative basis. It's like Bigfoot. You can't have negative basis. It doesn't exist. Okay? If you do, you have to record capital gain, in general capital gain. It might be ordinary gain, but at this point in the problems, we're going to assume it's going to be capital gain. Okay? So you're going to have capital gain for anything that's negative up to the amount to make your basis 0, because you can't have a negative basis. So what this is doing, these lines, is we're tracking two things. We're tracking what our basis is going forward, and also if our basis is negative, then we have to record gain. Those two things. Okay? So what we're going to do is, this is kind of our liability chart. And this is the best way to do this. You start at the top, just rolling over the bases of the items you've contributed under section 722. Think of it like you're starting outside basis. Then we go through all the respective liabilities for each owner. We first start with lemon. Lemon has a recourse mortgage of $270. Remember, in this problem, we're assuming that all liabilities are split equally. We will talk about liability allocation problems later on in later problems down the line. But right now, we're just going to assume they're all equal because the profit loss capital ratio is equal 1/3, 1/3, 1/3. So start with lemon's liability. The first thing you want to do is note relief. So relief of liability under Section 752 is treated as a deemed cash distribution. It's as if Lemon, right, who has the relief, is getting a cash distribution, and cash distribution reduces your basis. We're going to talk more about distributions later on as well, so you have to kind of keep these simple rules in mind. Distribution reduces basis. So the relief amount to Lemon is $270. Okay. Well, the partnership takes on the liability, and again, the partners are splitting the liabilities equal. So this is considered the partners taking on, and again, it's going to be split equally. So 270 times 1/3 or divide by 3 is 90, 90, and 90. So $270 of liability that Lemon is contributing to the partnership and the partnership's taking on is relief to Lemon that's treated as a distribution, which reduces your basis, Lemon's basis, and then taking on liability by all the partners, 90, 90, 90, increases the basis because it's viewed as a cash contribution under Section 752, like as if you're contributing cash. So we've done Lemon. Let's now look at Lime. With respect to Lime, let's do the same thing for Lime. So Lime's liability, we're told, is $60. So we have relief. So we go to Lime, 60. And we have, with respect to Lime's liability, which partners are taking on what? Well, 60 times 1/3 or divide by 3 is 20. So positive 20 to Lemon because Lemon's taking on 1/3 of that. Lime's taking on 20, and Orange is taking on 20. Okay, so now we've just finished Lime. Now we go to Orange. So Orange is contributing 0 basis accounts receivable and 0 basis accounts payable. With respect to 0 basis accounts payable, from a cash method taxpayer like Orange, these do not go into this analysis. That's the rule. They do not go into this analysis. We talked about that in the lecture videos, the lecture materials, that if a partner contributes 0 basis cash method accounts payable, they don't go into this 752 analysis, this liability analysis. So we're done. It doesn't go into this. So then we sum up our numbers. Starting with Orange, we got 110. So that means this is the adjusted basis afterwards. Lime, we've got 130 plus 90. What is that? 220. 240 minus 60 is 180. And then Lemon, you've got 140 minus 270. What does that equal? Negative 130. And then you've got positive 90 plus positive 20. So that equals negative 20. You can't have negative adjusted basis. Doesn't exist. Can't have that. So what we just did here, these liability steps, right? We did 721, 722 first. Then this part with the Lemon and Lime's liability, relief and taking on, that's what we do, the analysis we do under Section 752, where we find liabilities for partnerships. Now what we have to do is we have to look at, okay, if anyone has a negative basis, we have to record gain under Section 731 and 733, which are the distribution rules, which say in general, distribution beyond basis, which here there's no basis because it's negative, creates a capital gain. 733 specifically says that once you have a negative basis for cash, you then have to record gain up to the amount of that negative basis. So in conjunction with one another, we then record a $20 gain. So Lemon has a $20 gain, and that brings Lemon's basis to 0. So 0, 180, and 110 are the final adjusted bases in the problem. the final adjusted bases in the problem. So what I want to stress in this problem, we start with the partnership. Okay? Again, no gain or loss of the partnership. Also, with respect to the inside basis under section 723, we just roll over the bases of each asset that the partners contribute to the partnership. So that's where we get these numbers for these 4 assets and this liability. Then we also note that, hey, everything tax. Everything tax. Okay, so then we roll over to the partners. Think of the partners as a 2-step process when there's liabilities. But we join the 2 steps in the end in one transaction. So this is all one transaction, but think of it in 2 steps. It's the best way to think about it. So first thing we do is we focus on our basic 721 and 722 rules. Okay? We also, I forgot to mention this earlier, and it's important for now, tacking. 1223. Section 1223, tacking. Lemon's contributing land held for several years in investment and cash. So Lemon has a split holding period. Lime contributes section 1231 property and therefore has a taxed holding period. Orange would be all fresh start because accounts receivable, accounts payable are ordinary income. Now, why is that important? Because Lemon has a $20 gain, and the character of that gain, in general, under section 731 and 733 together, is going to be capital gain. Well, as we all know, capital gain makes a big difference if it's long-term capital or short-term capital. Well, part of Lemon's holding period, tax, so we can add on several years, right? But then some of it's fresh start because it's cash. So because Lemon has a split holding period, part of the $20 of capital gain is going to be short-term and part's going to be long-term. I'm not going to calculate the actual amount on my exam. If you're taking my class, as long as you know, hey, part of it is short-term capital gain, part is long-term, I'm fine. Because as I mentioned in the previous video, there's actually some discrepancy in the rule of how to allocate split holding period. There's differences in the rule, and I don't like to test it because students give me different answers, and there's different ways to allocate it. It's one of those things. So at least if you understand, hey, it's going to be split. It's not going to be all long-term capital gain. It's not going to be all short-term capital gain. It's split. Some is going to be short-term capital gain, and some's going to be long-term. Again, the reason why is because, hey, we held the land for several years, for more than a year, so automatically it's going to be long-term for that portion of the holding period. But the fresh start, the cash, we haven't even held it for a day for that portion. Because fresh start starts new. We start counting the next day. That's why tacking is important in this problem, by the way. So we then went through and we did the 752 analysis, starting with our 722 basis. That's why we do the steps, the order. 140, 130, 0 starting basis. We go through the liability count, the 752 liability distribution, deemed contribution. That's what we've done here. We allocate out. We get our ending adjusted basis. If anything's negative, we do gain. Guess what? Lemon had a $20 capital gain. Again, it's capital, general rule capital under 731, 733. And because of Lemon's split holding period, the portion that relates to the land gets long-term. The portion that relates to the cash gets fresh start, which is short-term because we haven't started counting yet because it's all the same day. We have a $20 partial, short-term, partial, long-term capital gain. The ending basis is 0, 180, and 110 for the owners, and that ends their adjusted basis. And that's the consequences to the parties. Before we conclude, I do want to give you the balance sheet in case you wanted to know what the balance sheet looks like. So let me write that out. I will move this down. So the balance sheet for this problem, in case you wanted to write it out and practice it, because I promised you that I'd put it at the end, even though we didn't really go through the specifics, right? Here are our assets again: cash, accounts receivable, building, land. Remember, when we do our balance sheet, just like problem 1, we've got our adjusted basis, we've got our book amount, then we've got our liabilities and capital. Now, the main difference between this problem and problem 1 is that we have liabilities in problem 2. We've got the land mortgage. We got 2 mortgages, and the partnership takes these on, right? And we've got the building mortgage. We don't have multiple columns for these. Just going to be 270 and 60, which equals 330. And then we've also have the capital accounts. Very important. Keep track of the capital accounts and partnership tax. And we have lemon, lime, and orange. And we've got our tax column, and we have our book column. Let's go back to the assets and fill that in. So again, these adjusted bases, with respect to the accounts payable. So you know how the problem also mentions that, also noting any potential issues and future issues? So, almost missed this. This one's something that's difficult to see, but it's an important tax rule. So for orange, we'll go back to the balance sheet. Orange contributes 0 basis accounts receivable, worth $350, and accounts payable, worth $150. Because orange has a 0 basis in the accounts receivable, that means that orange is a cash method taxpayer. So both have a basis of 0. Now, there's a special rule in tax. This is found in the rules for timing. Or if you have both accounts receivable and accounts payable, cash method 0 basis, you're contributing it to a business, or you're contributing it to another foreign business, whatever it is. If you contribute the 2, because the accounts receivable is greater than the accounts payable, we're able to net the 2 numbers. So after this transaction, the partnership does not have accounts receivable of $350 and accounts payable of $150. Simply, it's just going to be accounts receivable of $200. The book amount is going to be accounts receivable of $200. We're going to net the 2 numbers because the basis is still 0, so we don't have to separate them. That's why it's specific to cash method. If it's the accrual method, you have to separate them because they could have different bases. So it makes a difference. Now, we still need to consider the accounts payable in the 752 analysis, which we already did that. And again, accounts payable does not go in that, right? We talked about that already. Okay. So that means that we don't put accounts payable. So I put that on there. It's like, no, that's not what you do. So the cash amount, 40 for the adjusted basis, the tax adjusted basis, 40 for book, right? Historical cost. Accounts receivable is 0 because we roll it over. And our adjusted basis is 200. It's the net amount of those 2. The building is going to be the basis, which was given to us, is 130. And the book amount, we're told the value is 260. Finally, the land has a basis of 100 and a book amount of 430. Just the fair market value date of contribution. We add those up, we get 270. We add these up, and we get 930. Okay, so that brings us to our capital accounts. Remember, the problem tells us that each of them are contributing $200 net of liabilities. And if you go through, you'll see it. You take the values minus the liabilities. They each contribute $200, which means, hey, because they're arm's length, they're all going to get a partnership interest worth $200. So that's what their value of their partnership interest is going to be worth. Also, another way we can calculate that is, hey, if you take 930 minus 330, you get 600. And guess what? Assets equals liabilities plus owner's equity, so it has to equal. And 600 times 1/3 is 200, 200, 200. Tax amounts. So this is where you take the basis. However, it's a little different because liabilities. So this is one thing that differs from problem 1. So orange has 0 here. Now, I'm not saying it's the same as this. It's not the same as that, 110. You also have to consider the liabilities that go into it. Basically, the idea here is saying, hey, of the 330, orange's portion is 110 because 330 divided by 3 is 110. So we're going to see later on problems, whenever we consider the basis going forward, we always consider the portion of liabilities that are allocated to that owner. So technically, orange has a 0 basis plus 110. That leads us to, so 0 plus 110 leads us to the 110 that way. Same thing with lime. Lime here is 70 plus 110 is 180. So for lemon, you have to backtrack this one. Lemon has a basis of 0 minus 110, but guess what? Lemon recorded a $20 gain. So actually, the $20 is before. So it should be the negative 20. It should be this. To get negative 20 from 110, you need minus 130. And that brings us to a negative 60. So it's because that $20 of gain that was recorded, that's what brought us to 0. But again, we're looking at the capital accounts before that. We're focusing on this line. So it's a little confusing. You're focusing on the negative 20 for this calculation. Everyone see that? Not the 0. If you did 0, it'd be negative 110. And then it wouldn't balance, right? Because 270, assets equal liability plus owner's equity. So 270 equals 330 minus 60 is what? 270. So it has to balance, right? So that's why that fits in there. Okay? So before we conclude, now look at the problem. It's real, I know it's hard to see. Before we conclude, again, the problem specifically asks us to consider some additional, issues going forward. And I don't really want to worry about 704C and all that stuff because there's obviously built-in gains, built-in losses. We'll talk about those in other topics. With respect to orange, these accounts receivable, when they're collected, they all get allocated to orange later on, the full amount, the full $200. We don't allocate it 1/3, 1/3, 1/3. 66.67. We don't do that. All that goes to 200 goes to orange. Now, if they collect more than 200, then the portion above 200 goes. It sticks with orange and it keeps its character as ordinary, even if it wasn't viewed as that in the partnership level. Remember we saw that in section 724, right? That's under the assignment of income principles, who has to be taxed, and also section 724. All right, so that really concludes the problem, and I hope you enjoyed this long one.